What is the secret sauce to a great long-term portfolio? Now, what are the different assets that most of us look at as an investment? What are the most popular investment commodities in India? That's now worth a couple of crores, hundreds of crores. So it's also a new asset. What are the different types of asset allocation management? Why is asset allocation important? Now, what is asset allocation? If anybody were to ask me what is the secret sauce to a great long-term portfolio, I would say without hesitation, the number one reason is asset allocation. Now, what is asset allocation? Asset allocation is nothing but putting all your eggs in different baskets, like the grandma would have told us, right? So typically an asset allocation is nothing but dividing your investments across different investment classes. That's all there is to it. Now, what is the purpose of asset allocation? The purpose of asset allocation is simply to put monies in different places so that it suits your goals. Let's say you want to retire at some future point in time, or you want to educate your children, you need money for all that. So for your goals and your needs, that's one. Second is as per your risk appetite. There are some of us who can take great risks. Some of us may not want to take risks. So to match each of us, we will need to go that way. Last but not the least, some of us have money that you require next month, next year. Some of us have no need for money for the next 10 years. So we can invest according to that as well. So if you take all these factors into account together, is why one needs to look at asset allocation. Now, what are the different assets that most of us look at as an investment? One is, of course, equity. Equity can be equity shares, equity mutual funds. You could have other products like portfolios and various other investment classes, but all of them deriving from equity. While equity is a great investment option, it is also risky. The next one is what we call debt. Debt is nothing but the simplest debt instrument is your bank deposit. Two, there are very complex debentures and bonds on the other end. So one can look at any of those combinations. Debt is usually relatively safer, relatively less volatile, but also generates less return. Next could be commodities. What are the most popular investment commodities in India? It's gold. Yes, you guessed it right. Indians love gold, and so gold is a very important asset. So we buy gold in the form of jewelry, to coins, to biscuits, to why not electronic gold as well. Today there are a variety of different options to invest in gold, and electronic is the one that is least expensive and easy to hold. Next, you now have recently, the government has introduced silver as an asset class. Not only gold, but you can now invest in silver as well. That's the commodity side of investing. Next up, you have real estate. Of course, Indians have always loved real estate. So for the longest time, we have been investing in homes, in commercial properties, in farmland, so many ways to invest and generate capital appreciation, or you want to get a rental income, or both. All of it happen in the real estate space. The good part is people have generated great wealth holding real estate in the past. The not so good part is it's not a very liquid asset. So if you need money urgently, it's not the best place to get your returns or your liquidity from. That's real estate. Now, all of these are different assets, my friend, and you have a variety of different assets now in the form of art. Let's say you owned a very interesting piece of art that was drawn by, say, somebody like an M.F. Hussain. That's now worth a couple of crores, hundreds of crores. So it's also a new asset. So there are a variety of new assets. Wine is a new asset. Paintings are new assets. So there are different asset classes that are coming up now. But all of them have their own sense of risk and return at the end of the day and holding period. So depending on the kind of time you have and the kind of risk appetite you have, you need to look at investing in these. Now, what are the different types of asset allocation management? There are broadly two very distinct varieties of asset. Now, the reason why we hold asset allocation is that at various points in time, you need to rebalance so that you stay true to that asset. What do we mean by rebalance? Let's say you had a portfolio that was 50% in equity and 50% in debt, and you had a great stock market year where whatever you invested in has doubled. Then at the end of that period, you need to go back and redistribute it so that it comes back to 50-50. And that's what rebalancing is all about. So there are two ways to do asset allocation rebalancing. One is what we call the fixed. The other is what is called a dynamic or tactical. The fixed one is, like I mentioned, if you say 50-50 between equity and debt, at all points in times you will work to make sure it is 50-50. And what is dynamic? Dynamic is you take into account market realities or your own requirements and then feed it at the end of the period. So you will make small changes to this asset allocation. Suppose you started with 50-50 as an example. Let us say equity 50 and debt 50. And for some reason, the stock market became very, very cheap because of an extraordinary event. And it's so cheap, it's so inviting to invest that you may decide instead of 50%, I will go to 70% in equity now. So it's a very tactical call that you're making, and that's called a dynamic asset allocation. So between fixed and dynamic, both are extremely powerful ways of allocating one's investments and creating wealth. But we have found that if done diligently, the dynamic asset allocation offers a slightly better advantage to the investor. Like I mentioned, the important word is if done diligently. Now that's the important part. Why is asset allocation important? The first and important reason is that it prevents over concentration of money in one asset, which is always a danger and a risk. So first up, asset allocation is important to give your investment a great spread. That's very, very necessary. Second is the negatives of a sector doesn't kind of impact you all through because you've diversified your portfolio. Let's say real estate was growing through a bad phase. Now, because you've asset allocated and you have money in other places, your other monies continue to grow irrespective of real estate not performing. So that's really a great way to mitigate risk. And third is asset allocation provides a balanced way for you to grow your wealth without taking too much of risk. I think these are great reasons why all of us need to go and check our portfolios whether we have reasonably good asset allocation in place.